Hi there, welcome to Kneppy Invests. Today I'm going to just be discussing something that's of a bit of concern to me just because I've been seeing this misconception, this misunderstanding a lot recently, especially the last 4 or 5 months. I never saw this before pre-COVID, so there's a lot of new investors coming into the market and the lack of understanding is concerning to me. The other thing that's really concerning to me is it's actually a sign of a bubble when you get all these new people entering into a market. It's actually a telltale sign of a bubble, so that's concerning also. So this question today, this concern of mine today is around people misunderstanding that a share price is not a sign of value. You cannot just look at a share price and say whether it's cheap or expensive, especially when you're comparing it to another company. So for instance, if there's a company at $10, it's not cheaper than another company or necessarily cheaper than another company has a share price of $20. It's just one little factor. And a lot of people just don't understand this very simple concept. And honestly, if you don't understand this concept, if you don't understand that CSL at $270 doesn't mean it's more expensive than a company that's $3, if you don't understand that concept, then you should do more learning before you enter the stock market. It's one of the most basic concepts to understand, that you need to understand that. And so this first slide is just I got from it was either Hot Copper or it could have been some Facebook community group where someone was comparing three iron ore mines, Phoenix, Strike, and Flinders mines. And all they did was circle the share price and underlined some deposits and some other stuff and said, what do you think here? This share price is 4 cents. It should be higher. There's other two companies with share price of 16 and 14 cents. Fortunately, the replies there were absolutely right. You circled the wrong thing. Share price is meaningless. You don't have a context there. There is a context here because they do have a market cap listed, but he didn't even look at market cap. Market cap's way more important. You can see Flinders Mines, even though it has a share price of 4 cents, 4 times lower than Phoenix, has a market cap almost 5 times greater than Phoenix. It's the market cap you had to be looking at in this case because that shows you how expensive or cheap a company is. And even market caps doesn't really tell you how expensive or cheap it is because you've got to do an evaluation of the company. A market cap of this case of Flinders Mine, 198 million, that could be extremely expensive if they, have nothing to look forward to in the future, or it could be amazingly cheap if they've got, operating cash flow of $100 million a year. That's really cheap. So it's all about context. A share price in itself tells you nothing. And the reason I'm doing this video today is because I was listening to a podcast on my run today, and there was a question from a new investor, 22-year-old new investor, to the two guys who were doing the podcast. He says, worth investing in companies in which the share price is expensive. And that fact that he said share price is expensive just triggers some alarms, or allocate my capital to cheaper shares where I can buy more. I'm seeing this thing a lot where people think if a share price is low, it must be cheaper. It's just astonishing to me how much I'm hearing about this. And I'm going to get 2 examples now where we have a share price of $250,000 compared to a share price of 0.8 cents, where one is cheap and the other one is expensive. The cheap one isn't 0.8 cents, let me tell you that much. So Berkshire Hathaway, most people should have heard of Berkshire Hathaway. So they have 2 classes of shares, Class A shares, where they haven't done anything, they haven't done any consolidation or stock splits, usually because that's where they get cheaper. And when I'm talking about stock splits, it just boggles my mind that Tesla and Apple did stock splits. And as soon as they did the stock splits, the share price ran up because a lot of retail investors went, oh my God, it's cheaper. I'm going to buy some. It's not cheaper. Anyway, so Berkshire Hathaway Class A shares were down as low as about $250,000 a few months ago. When I looked at it at $250,000, I went, this is cheap. $250,000 cheap. Now, just all you have to do is know that Class A shares and there's Class B shares. Class B shares, I forget what their price they are, but they're significantly less than 250,000. Yet they're measuring the same company. And that should be a telltale sign that a share price means nothing by itself. Now, the next company is a company called Boart Longyear. About a year ago, the share price of Boart Longyear was 0.8 cents. I looked at it and went, no way. Not only was it expensive, there was 26.3 billion shares on issue. Now, with 26.3 billion shares on issue, the only thing they could do was do a consolidation to decrease the amount of shares on issue. So they decided to do a 300-to-1 consolidation, which means if you had 300 shares before the consolidation, you're going to have one after. So they went from 26.3 billion shares on issue to 88 million. And the share price went from 0.8 cents to $2.40. Even at that point, it's way too expensive. Not because of the share price. It's just the fundamentals of the business. They had a lot of debt. They're still bringing in some revenue, a lot of debt. They were struggling to have operating cash flow, even if they did have positive operating cash flow. So this was a no-go for me. And since the consolidation, the share price has gone from $2.40 to 38.5 cents. In fact, I should have a look at this again because it could be getting to a point where the share price is looking good. I might put this on my turnaround stock watch list, possibly. So hopefully, if you think just by looking at a share price, comparing a share price between two companies where the one is expensive, the other one's cheap, share price alone does not tell you anything. So just ignore that, please, for the love of God. Anyway, I won't get into how you can value a company. There's a lot of different methods to value a company. For DCF, for example, maybe you can look at PE ratios, that sort of thing. So I won't get into that now. I don't use any of those two. But I'll maybe do a video on what I look for or what I do to value a company. But that's another story. I hope you did get a little bit out of this video. I'm getting frustrated with the amount of people entering the market where they have a lack of knowledge. It's a bad sign for the future because it does mean there's a lot of uneducated people entering the market, and that is always a sign of a bubble. In fact, back in March, there's one guy I've been listening to who says the main reason this is not a bubble bursting is because before COVID-19, there was not as many retailers entering the market. Now, he might be thinking differently because the amount of retailers who are forcing the prices up, and they're forcing the prices up based off two things. Buy the dips and buy companies you know. So that means buy the dip. Whenever there's a dip in the share price, these retailers are just entering the market without even thought of valuation. And the other thing is buy companies you know, which they've been told this for decades or years. That's been forcing up share prices of Apple, Facebook, Tesla, because people are thinking, I know this company, I've heard about it, so I'm going to buy it without even thinking about the valuations. And that's what's happening right now. It's scary what's happening with the valuations. There's a disconnect between the share prices, which have been going up, and we're possibly seeing a top in the share price or the markets right now. We are seeing a bit of a pullback. So there's been a disconnect between what's happening with the share price, the market valuations, and what's happening with the earnings. First time in history this has happened where there's been this disconnect between the two. It's never happened before. So I'm not fully invested at the moment, but I am a little bit invested because bubbles can run a long time. So I don't know when it's going to pop. This could be just a little bit of a correction and it could go higher. So that's all for today. Hope you've taken a little bit out of this. Yeah, I'm not that angry, but it's frustrating to see all this. Have a good day, and I'll talk to you later.